Hello traders, it's Saturday, February the 15th. This is John Kicklighter, Chief Strategist for DailyFX.com, here to give you a weekend wrap-up for this past trading week, as well as an outlook for what we can expect in the week ahead. We are making a transition from one market of exceptional consistency and what seems to be a theme of risk on that has brought us up to tremendous levels. For some benchmarks, that means back up to record highs like the S&P 500. So we move into next week with technical resistance, questionable fundamental support, and a lot of speculation from the markets of imminent reversals. We'll look at all this over this video, and I do want us to think it in terms of smart trading setups. All right. So this past week, how would I describe it? A lot of assumption for consistency, and a lot of that expectation through that move was risk on. Wasn't necessarily risk on, though. That's something we have to discern from our analysis. The S&P 500 was a big part in played in this assessment, this theme of positive risk appetite. We have here the S&P 500. You can see a pretty consistent move, some remarkable green bar series here. And that move brings us very close to that record high that we set through the beginning of 2014. The interest, of course, is that we've had a rebound, and a dramatic one at that, having mounted a 6% correction. This looks a lot like the corrections that we've seen in this dominant bull trend so many times before over the past 5 years. So the question is obviously, is this just the necessary pullback before we get that continued march higher? Well, this move that we've had certainly does fit that bill, but as we've talked about before, it's much more difficult to convince the markets of consistent drive higher and new record highs when you are already there and at an extended position. So this alone should not be giving us a reading of risk appetite, and furthermore, I'm going to give you some highlights about why this is also something of a dubious performance itself. But we also had on the FX side a substantial drop in the US dollar. Now, we've been talking about this move, and I've been noting it in the daily fundamentals on a regular basis. This is a remarkable 10-day straight decline. Massive move. All right. Well, in terms of where it's at in the broader trend, it doesn't necessarily reverse the circumstances. It doesn't instigate a new multi-month trend all on its own. And it certainly hasn't even covered that far of a distance. All right? So despite the fact that it's a 10-day decline, we really haven't put much momentum behind it. But the consecutive sessions, that is unusual. In fact, looking at the historical count, since this Dow Jones FXCM dollar index has been around, and it's been around since the beginning of 1999 with the invention of the euro, or the trading of the euro, you can see here we have only had one other instance of a 10-plus day decline. All right, and that was way back here in 2006. This has been a pretty remarkable move, and you can see that declines of this magnitude, looking at the two other, this is a 9-day decline and this is a 16-day decline actually, they were in a much more prominent bear trend. All right, so you can't take much from that though, because it's only two instances of a move of that magnitude. But I do want to reference the amount of momentum that we've had in this move. So what I wanted to do was look at anything over an 8-day decline and tally its performance. All right, how many pips it actually moved in that series. Well, in this particular performance, we have moved very little. All right. In fact, let's see what we did here. It was about 156 pips. All right, 156 pips for 10 days. That is not very significant at all. You can see that 10-day or 8-plus day moves in the past to the upside and downside have been far more prominent. All right, so this is a contradiction in terms that we do have remarkable consistency, yet you don't have much in the way of conviction. Very similar to the circumstances we have with the S&P 500. You have a lot of momentum, and there's consistency, you have a lot of consistency here, but you don't necessarily have a lot of conviction behind it. Now, breaking this down, We can look at something like, and we've talked about this in the previous strategy videos, the measures that we can look at to establish whether risk on or risk off is a major and prominent theme with momentum. And we can already tell from a number of factors that this is not necessarily the case. This is actually the S&P 500 futures versus the Nikkei 225 futures, so they align better. And they do deviate historically, but those deviations do not last long. The correlation between major liquid equity indexes or major financial centers and their equity indexes does not deviate very far. Risk on, risk off tends to align them all. Now, when risk trends are very strong, we know that this relationship between global equities tightens up, and as it grows even stronger, we start to move into various other asset classes. That's what we were looking at when we reference the risk severity or the risk depth curve. All right. As risk aversion or risk appetite, if it were in the opposite direction, increases in intensity, we have relationships between different markets starting to align to those risk themes. So something like a Euro USD, which is traditionally very difficult to align to risk trends, will start to trade in that manner, risk on, risk off. So the equity comparisons, the relationship between the Nikkei 225 and the S&P 500, you can throw in the FTSE 100, the DAX, the German index, and many other indexes of liquid markets, they should prominently show a positive relationship of high consistency if you're talking about a really strong and convincing risk on. That's not something that we're seeing. Furthermore, the level of relationship to volatility is something to be concerned about. I noted this in the real-time news feed earlier on Friday. You can see here at the bottom of this chart we have the ATR, which it's 20-day ATR, which is equivalent to a one trading month. All right. ATR is a very good indication of volatility. It's a substitute for the VIX. All right, so rather than looking at implied expected volatility going forward, we actually look at actual volatility, also called realized or historical volatility. Now you can see in this activity gauge that it's much like what we see with the S&P 500. All right, the S&P 500 versus the VIX. Now you've seen this chart enough that you know that I flipped the VIX upside down because it aligns to the S&P 500 nicely in this manner, because a drop in the market is typically more violent and it draws out risk aversion. There's a long bias to equities. There's also a hedging qualities to the measure of the VIX, and that is an insurance product. All right, so this is a good inverse correlation between the two of these. Now what's interesting is that we've had, so you can see the pickup in ATR or volatility here, and that coincides nicely with the decline. That's generally what you would expect from these moves. Now what's interesting with this current production is that we had the pickup in ATR with this initial decline, but it continues to rise, and it's actually its highest since back in July, even though the S&P 500 is rising. All right, there's a very aggressive pace behind this rebound. Is this conviction, or is this something else? I don't think this is conviction, because when we look at other circumstances that surround conviction, we would expect high level of volume. So investors would be increasing their exposure. Well, when we look at volume itself, we can tell that it's really not we're not seeing strong participation in this move. When we look at something like open interest, similar circumstance, very similar. You don't have a strong participation behind this move, and the level of conviction is thereby something of a concern. We have this aggressive move into this peak, into a major technical resistance, and the circumstances surrounding its ability to break higher and continue higher are something of a concern. When we look at the historical relationship between the ATR as a volatility measure and it's in the S&P 500, what I have here at these green lines is every time we see the ATR rising in a meaningful way, at the same time the S&P 500 is rising in a meaningful way. So there's a positive correlation behind them. In terms of magnitude, and the magnitude of the underlying move and the magnitude of the ATR increase, we haven't seen a circumstance of this like this in the past decade. All right, you can see a number of modest pickups here in the ATR, or it doesn't really align nicely to the S&P 500 performance. It's just a rebound here. And there is nothing that we can relate to in a historical circumstance. This lack of reference is very concerning, because it's unprecedented. And if it's unprecedented, we have to consider the other circumstances around it. So what would this reflect if not a really robust move that is going to break 1850 and subsequently see a continuation of conviction? Well, it might be a threat of reversal, and this move might be a deleveraging of short interest, which was something that we discussed earlier this week. So there were a lot of speculative shorts that were building up their positions with this decline. Well, as it started to move higher, those bears were shaken out. You had a short side squeeze, all right? And as they're squeezed out, they unwind, and it creates an aggressive rebound. But is this necessarily a big pickup in new longs? No. What happens when those short side investors leave, or they fully exercise their position? It then depends upon the bulls to start coming in more meaningful numbers. And that might not come, because what's driving the S&P 500 higher? What's driving risk appetite higher? Well, we don't have the exceptionally robust growth expectations. We don't have new expected rounds or waves of stimulus coming. The Fed is tapering. The outlook for returns is easing up a little bit because of the level of these markets versus the rate of return they offer. The yield is going to be actually quite lackluster on a historical basis. So there isn't a very strong fundamental conviction behind this move. Doesn't mean it can't go up, but it does mean that it's going to be severely limited in its upside performance, especially compared to what would happen if we potentially saw a major reversal in fortunes. All right. Now, I talk exclusively about whether we should or how we should pick tops and bottoms, because I know that a lot of people do look for these tops and bottoms. But the S&P 500 and the reflection on risk trends is not the only thing that we are establishing possible calls of continuation versus reversal. We can also look to some of these majors. Right. In the dollar's aggressive decline, I think one currency pair that has really stood out is the pound dollar. Now, this past week, we had the release of the Bank of England's quarterly inflation report. That was on Wednesday. That was a big driver. And for the U.S. dollar, we had Yellen come up and suggest that they would continue with taper, and she took away she softened, just like the Bank of England did, their forward guidance. Was that necessarily dollar negative? No, not really, but nevertheless the dollar did extend its decline, and perhaps one of the best performers in this reflection has been the pound dollar. All right. Subsequently, the positioning for the pound dollar has gone to extreme levels. All right. So you have here a weekly change basis for the pound dollar, and you can see I only indicate over 300 pip moves for this on a weekly basis. This has been one of those 300 pip moves. We haven't seen another one of these since late 2010, all right, before this particular one here, I believe, is in June. So we don't really have many of these big moves, and previously, if we look at big moves to the upside and downside, they often coincide with terminal indications. This is perhaps what traders are looking at when they look at big moves of that magnitude. They see maybe the top of this rising trend channel. They see perhaps this 50% fib of this decline from the July 2008 to January 2009 bear wave, and they say this is an overdone rally. There is subsequently some technical resistance ahead, and I'm going to try to pick a top. All right. And you can see that effort here in the SSI positioning. You can see all this in Daily FX Plus. We update it on a daily basis, and this is definitely something you're going to be watching on a daily basis as we update it going forward around these extremes. But you can see here that traders are short nearly 9 times the amount of positions that they are long. So in other words, they have 9 shorts for every 1 long. What's the dominant trend here? What's the dominant trend over the past, let's say, a couple of years? Is neutral. What's the dominant trend for the medium term? Definitely bullish. And what's the trend for the short term? Is bullish. All right, so people are trying to, in essence, pick a top here against a very prominent medium to short-term trend. That is a dangerous circumstances. Tops and bottoms occur very rarely, and trends are natural states of the market, whether it be up, down, or sideways. All right, so this is a low probability scenario that a lot of traders are trying to pick up on. All right, this is why I had to cover this specifically in the strategy video, because it's a very dangerous approach to the markets. However, there's always a probability that this is going to be a correction. All right, you have to see the circumstances that surround it, and you have to play it smart, however. And it's not a good practice to inevitably or try to pick the very top. It's better to wait to see a turn and then start to trade when the circumstances turn in the reversal's favor, fundamentally, technically, and market condition-wise. All right, a lot of traders were exceptionally long even before we had this bar. They've only increased their positioning short after this massive buildup. So they are now 300 pips. Some people are 300 pips in the red, and they've increased their positioning. A better approach would be to see first the turn to the downside, then interest rate expectations for the British pound start to break down. Perhaps the US dollar appeal start to rebound. And then you start to see market conditions through this high positioning start to unwind. That would give us a good prospect for a turn. All right, that would give us a higher probability. But we have to look for those probabilities. We have to skew them in our favor, and this isn't necessarily in our favor. This is actually happening on a number of pairs, and the pound dollar just happens to be one that truly stands out. The other extreme in the SSI world is the Kiwi USD. We have very similar circumstances for extremes, actually about or over 8 shorts for every 1 long. But as you can see with the Kiwi dollar versus the pound dollar, you don't really have an exceptionally strong medium to long-term bull trend. You have neutral for the long term. You have neutral for the medium term. You have bullish through the short term, however. This is much more of what we call range conditions. All right, so we're at the top of that range, and this has good range support, range resistance up here. This is actually, it looks like a higher probability circumstance. It still would benefit from something that says it's going to pull back or correct, but this certainly does look better on with those elements. All right, so we have to look at these kind of market conditions in perspective of probability. All right, this is something I talk about on a daily basis, and it's not just for individual currency pairs. We also need to apply it to general risk trends. The S&P 500, the US dollar, being on opposite ends of that spectrum as a risky asset versus a safe haven, respectively. All right, and that's something that we're going to have to keep in mind for next week. But will we have a good opportunity to see a reversal for risk trends next week? All right, risk trends are going to be very important to the circumstances of many of these market benchmarks. Not necessarily the Kiwi dollar or the pound dollar, however, interestingly enough, because they are not highly correlated to risk on, risk off. But if we do have strong risk aversion, watch how quickly those relationships start to improve. Nevertheless, looking at the docket for next week, we do have some high-level events, and we do have some unusual circumstances, especially to open the market. On Monday, we have a U.S. market holiday. Now, obviously, there is not one market. There are many markets open, and the liquidity will not fade just because one market is offline. However, it does have a substantial influence on breaking the transmission of risk on, risk off. All right, so sentiment, as it starts to spill over to other sessions, is disrupted. When we have that disruption, it's actually very difficult to maintain momentum and as well to drive a reversal. All right, so the circumstances of reversal versus continuation are going to be very tough to open next week. That being said, when you do have something like this that can put a brake on a move like the pound dollars or on the move like the S&P 500, it actually helps to curb first the move, and then it encourages speculators that have ridden the bull trend to start taking profit, and then as they take profit, the market starts moving back, and we start tripping stops, and it can lead to kind of a waterfall effect in a reversal. So there are scenarios that have happened like this, and has happened many times in the history of trading. Doesn't necessarily mean it has to happen now, but it does set up those kind of conditions. So you have to be very careful about gauging this weather vane for sentiment. But it does present us with some opportunities. So don't just think that Monday is a throwaway trading day. It can actually give us some pretty remarkable developments. I'm also going to be watching it through the open of the week, both the Japanese GDP and Bank of Japan rate decision. These yen crosses move, yes, on risk trends, but they are also moving very prominently on the expectations of a further Bank of Japan stimulus program. And recently we've heard that stimulus call really soften from the central bank. That is a concern, because to keep this going without the support of meaningful yield, which these carry trades are not providing us, you need further stimulus to push us down, or exceptionally robust risk appetite trends. Risk trends are encouraging. However, when we look at that, the relationship between the S&P 500 and the Nikkei 225, all right, that's when we have to start to question the robustness of risk trends. When we start to look at the technical bearings of the Nikkei 225 on its own, that's when we start to have to questioning risk trends. Because as you can see here, Nikkei 225 has held up previous support as new resistance and taken a dive from 15,000. That is, when you put this relationship between equity index and yen cross, you get the picture. All right. So I'm going to be watching these yen crosses. The BOJ rate decision is going to be particularly important with this event, with this currency pair. I still have my dollar yen short. I was short on this initial break from around, I believe, 102.20. So I'm not really very far in the money, and I have not built up to a full-size position. Why would you in this chop? But if we do have something of a build-up in the risk aversion theme, this could be something that truly does gain some traction. Now, a lot of yen crosses are risk sensitive. I'm going to be interested in what the euro yen does. All right, this has a wedge formation that is very prominent here, which can easily lead to a breakout if it aligns nicely with a underlying risk move or an underlying interest rate expectation move for the Bank of Japan, or QE expectation as it were. This has great potential as well. Similar circumstances for pound yen, as well as the Aussie yen, all right, CAD yen, and of course the Kiwi yen looks good as well. These are all great setups, and they have immediate event risk that we can work with at the open on Monday. Now, getting into the rest of the week, we'll watch risk trends as they develop around the ebb and flow of liquidity, but then we have to get back into the major event risk for the week. We have US CPI, we have G20 meetings through the end of the week, and I think one very prominent player that we will be watching as we get another round of data, important data for it, is going to be the British pound. Don't just look at the cable, though. Look at pairs like the euro pound, as it's at the bottom of this channel. If the pound really is going to rally, this can break that support level and continue lower. Also, keep an eye on pairs like the pound Kiwi. All right, having bounced off of the bottom of that channel, this has great technical bearings that it can continue with. Same with the pound Aussie. All right, this has actually held up to that trend line and continue this much larger dominant trend. But what are we going to be watching for the pound? Well, after that really remarkable run for the cable, we need to keep a very close eye and look at what happens with the CPI data, as well as the employment and Bank of England figures, or the Bank of England minutes. The Bank of England minutes are probably not going to be as remarkable because we did have the quarterly inflation report just this past week, but these job figures and the CPI figures are going to be very important. The Bank of England has transitioned to reacting to data. This is the data they work for. This is exactly their the key data and their mandate. So we're going to be watching these figures particularly, and with the pound dollar, since that is our reference for incredible volatility. Thursday's U.S. CPI will carry great weight with how this relative rate hike expectation player right here is going to develop. A lot of event risk and a lot of extreme interest when we look at something like risk trends, and extreme positioning when you look at something like the US dollar. There's a lot of opportunity to trade this coming week and the coming weeks ahead, but you have to play it smartly. All right? If you're going to try to make positions on these exceptional fundamental, technical, and market condition perspectives, you have to come in with a plan and you have to execute mechanically. You can also attempt to try to get away from some of these more difficult circumstances, more tough to read. You can look at pairs like Euro Pound, which gets a little bit further away from the risk on, risk off element or the relative monetary policy element. You can look at pairs like Aussie CAD. Look at how consistent it is with technicals. All right, this is not a risk on, risk off element. Aussie Kiwi, all right? Even dollar CAD has a more persistent path. It's much more stable. So you can try to go for the glory, the big home runs in terms of fundamentals and market movers, or you can try to go for the more quiet and consistent. All right, just make sure that you know what you're trading and that you're trading it smartly. All right, I hope you guys have a fantastic weekend, and we'll start doing some more analysis for next week on Monday.